Good day, classmates and prof. Before we proceed with our topic, let me introduce us first as the presenter, Miss Elizabeth Campos, Miss Alia de la Cruz, and me, Christine Joy Velarde. Going back with our topic, portfolio construction, let me explain what is portfolio construction. Portfolio construction is the process of understanding how different asset classes, funds, and weightings impact each other, their performance and risk, and how decisions ladder up to an investor's objectives.
The main objective for portfolio construction is to build a suite of investment from a range of asset classes that balances the needs for cash protection from market downturns and consistency in returns with your long-term growth objectives. We believe that taking an active approach to portfolio construction and the management of risk and return in our clients' portfolios adds value in many situations.
The portfolio planning process never ends when investing for long-term goals. Changes in life stages such as employment changes, baby's divorce, death, or shrinking time horizons may necessitate adjustment to investors' goals, risk-reward profiles, or asset allocation. As changes occur, or as market or economic conditions demand, the portfolio planning process is restarted with each of the 5 processes repeated to ensure that the appropriate investment strategy is in place. Assess the current situation. A clear understanding of an investor's current situation in relation to where they want to be is necessary for future planning. In light of investors' most important objectives, this necessitates a comprehensive assessment of current assets, liabilities, cash flow, and investments. In order for the assessment to be able to identify any gaps between the stated goals and the current investment strategy, goals need to be clearly defined as quantified. An open discussion about the investor's values, beliefs, and priorities must be part of this step because they all set the course for creating an investment strategy. Step 2. Establish investment objectives. Identifying the investor's risk-return profile is central to setting investment goals. Deciding how much gamble a financial backer is willing and ready to expect, and how much unpredictability the financial backer can endure. Critical to figuring out a portfolio methodology that can convey the necessary gets back a satisfactory degree of hazard. Benchmarks for monitoring the portfolio's performance can be established once an acceptable risk-return profile has been established. By comparing the performance of the portfolio to benchmarks, smaller adjustments can be made along the way. Determine asset allocation. Utilizing the gamble return profile, a financial backer can foster a resource assignment methodology. The investor can allocate assets in a manner that maximizes diversification while focusing on the anticipated returns by selecting from a variety of investment options and asset classes. Based on acceptable ranges of portfolio volatility, the investor can also allocate percentage to various asset classes such as stocks, bonds, cash, and alternative investments. The resource designation methodology depends on the depiction of the financial backer ongoing circumstances and objectives and is generally changed as life changes happens. For instances, an investor's allocation may shift to reflect a lower tolerance for risk and volatility the closer they get to the retirement goal. Step 4. Select investment options. The parameters of the asset allocation strategy are taken into consideration when selecting individual investments. The investor preference for active or passive management largely determines the type of investment chosen. Individual stock and bonds may be included in an actively managed portfolio if there are enough assets. Typically more than $1 million to achieve optimal diversification. Professionally managed funds such as mutual funds or exchange-traded funds can provide adequate diversification for smaller portfolios, using index funds chosen from various assets, classes, and economic sectors. An investor can create a portfolio that is managed passively. Step 5. Monitor, measure, and rebalance. In the wake of carrying out a portfolio plan, the administration cycle starts. This includes keeping an eye on the investment and evaluating how well the portfolio does in comparison to the benchmarks. Investment performance must be reported on a regular basis, usually every 3 months, and the portfolio plan must be reviewed annually. One time each year, the financial backers, circumstances, and objectives get a survey to decide whether there have been any massive changes. After that, the portfolio review checks to see if the allocation is still in line with the risk-reward profile of the investor. If not, the portfolio can be rebalanced by purchasing investment with greater upside potential and selling investment that have achieved their goals.